Good morning to everyone. We are on our last topic for this course, which is Chapter 10, Ethical Decision Making, Trust in Corporate Governance, Accounting, and Finance. The objectives of Chapter 10 is first, explain the role of accountants and other professionals as gatekeepers. Second, describe how the conflicts of interest can arise for business professionals. Third is outline the requirements of a Sarbanes-Oxley Act. Fourth is describe the causal framework. Fifth, define the control environment and the means by which ethics and culture can impact the environment. Sixth, discuss the legal obligations of a member of a board of directors. 7. Explain the ethical obligations of a member of a board of directors. 8. Highlight conflicts of interest in financial markets and discuss the ways in which they may be alleviated. 9. Describe conflicts of interest in governance created by excessive executive compensation. And lastly, 10. Define insider trading and evaluate its potential for unethical behavior. As Hillary Clinton once said, in almost every profession, whether it's law or journalism, finance or medicine or academia, or running a small business, people rely on confidential communications to do their jobs. We count on the space of trust that confidentially provides. When someone breaches that trust, we are all worse off for it. And now for the introduction of this chapter. We will first talk about the scandals of the early 2000s, involve fundamental questions of corporate governance and responsibility. Next up is there were a rush of problems associated with the financial meltdowns in 2007 to 2008. Third is the ethics in governance and financial arena is now the most visible issue in business ethics. As something that is essential in most social relationships, trust is an ethical, warranted reliance on another. Analysts contend that corruption is evidence of a complete failure in corporate governance structure. So what is corporate governance? Corporate governance is the structure by which corporations are managed, directed, and controlled toward the objectives of fairness, accountability, and transparency. The structures generally will determine the relationships between the board of directors, the shareholders or the owners of the firm, and the firm's executives or management.
Professional duties and conflicts of interest. The collapse of Enron Corporation brought the ethics of finance to prominence at the start of the 21st century. Several important categories of business professionals, for example, lawyers, auditors, accountants, and financial analysts, function based on the internal control that exists within market-based economic system. Role identities determine ethical duties and provide a source for rules which determine how professionals ought to act. Gatekeepers act as watchdogs to ensure those in the marketplace play by the rules and conform to the market functions as it should. The most basic ethical business issue facing gatekeepers involves a conflict of interest. This exists when a person holds a position of trust that requires that he or she exercise judgment on behalf of others, but where his or her personal interest and or obligations conflict with the proper exercise of that judgment. Conflicts can arise when a person's ethical obligations and their professional duties clash with personal interests. Such professionals are said to have fiduciary duties, a legal duty grounded in trust to act on behalf of or in the interest of another to their clients. Figure 10.1 Conflicts of Interest in Public CPA Activity. Because professionals' gatekeeper duties are necessary conditions for the fair and effective functioning of economic markets, they should trump other responsibilities to one's employer. But knowing one's duties and fulfilling those duties are two separate issues. The gatekeeper function is necessary, but self-interest can make it difficult to fulfill gatekeeper duties. Society has a responsibility to create institutions and structures that will minimize these conflicts. Critics say government regulatory rules alone will not avert financial crisis. Extraordinary executive compensation and conflicts of interest within the accounting and financial industries have created an environment where watchdogs have little ability to prevent harm.
The Sarbanes-Oxley Act of 2002. A string of corporate scandals shook investor confidence. The U.S. Congress passed the Public Accounting Reform and Investor Protection Act of 2002, commonly known as the Sarbanes-Oxley Act or SOX Act. The act is enforced by the SEC, or also known as the Securities and Exchange Commission, and applies to more than 15,000 publicly held companies in the US and some foreign issuers. The European Union, 8 directive covers many of the same issues. Some states issue similar legislation that applies to private firms. So essentially, SOX requires that a company have a well-documented internal control over financial reporting, and part of that is segregation of duties. That means certain processes should involve multiple people so one person can pull off a fraud by himself. An example of this is accounts payable. The person who sets up a new vendors, the person who enters invoices, and the person who approves payments should not be the same person. That way, one person can create a fictitious vendor, submit fake invoices in the system, and get paid. With proper segregation of duties, there would be reviews along the way. Similar segregations are done across all areas of the company. Secondly, no regulatory fix is perfect. The Act is intended to provide protection where oversight did not exist. Oversight in terms of accountability and responsibility. The following sections mention impact corporate governance and boards. Section 201 states services outside the scope of auditors, no consulting rather than auditing. Section 301 states public companies audit committees, mandating majority of independence on any board and total absence of current or prior business relationships. Section 307, rules of professional responsibility for attorneys. Section 404, management assessment of internal controls. Section 406, required codes of ethics for financial officers. Section 407, disclosures of audit committee financial expert, requires that they actually have an expert. So essentially, each of these sections of the SOX Act plays a crucial role in improving corporate governance practices, strengthening oversight responsibility of boards of directors, enhancing transparency and accountability in financial reporting, and ethical conduct. These provisions were introduced in response to corporate scandals, as mentioned in the early 2000s, to restore confidence in investors and the integrity of the financial market. The internal control environment. The internal control mechanisms are established internally to comply with financial reporting laws and regulations. One way to ensure controls is to utilize the framework advocated by COSO, or also known as Committee of Sponsoring Organization. It is a group of audit and accounting organizations seeking to improve reporting through a combination of controls and governance standards, called the Internal Control Integrated Framework. So, the COSO framework supports corporate governance efforts by providing a common language structure for discussing internal control issues among management, boards of directors, auditors, and so on, enhancing transparency and accountability within organizations by promoting a systematic approach to managing and monitoring internal controls. So, in summary, COSO is a valuable tool for organizations seeking to establish robust internal control system that ensure compliance with financial reporting laws and regulations, adhering to the principles and components outlined in the framework. Organizations can enhance their overall governance practices and maintain the trust of stakeholders in their financial reporting success.
Good morning. I am Kervin Ilustra and I will discuss the internal control environment. So the elements or compromising control structures there are currently 5 elements that compromises the control structures are the control environment. The control environment is a cultural issue such as integrity, ethical values, competence, philosophy, and operating style. So the next element is risk assessment, and followed by control activities, followed by information and communications, followed by ongoing monitoring. COSO standards for internal controls move audit, compliance, and governance from a numbers orientation to concern for the organizational environment. Both internal factors such as the COSO controls and external factors such as the Sarbanes-Oxley requirements must be supported by a culture of accountability. COSO developed a new system, Enterprise Risk Management Integrated Framework in 2004. Serves as a framework for management to evaluate and improve their firm's prevention, detection, and management of risk. Expands on the prior framework to include objective setting, assist an organization in resolving ethical dilemmas based on a firm's mission, its culture, and tolerance for risk. According to Peter Drucker, whenever an institution malfunctions as consistently as boards of directors have in nearly every major fiasco of the last 40 or 50 years, it is futile to blame men. It is the institution that malfunctions.
Moving on with going beyond the law, ethical board members. The corporate failures of recent years highlights major deficiencies in both corporate governance and regulatory oversight. Board of directors have not effectively carried out their duties, resulting in poor management and flawed decision. Furthermore, government authorities have not imposed strict accountability standards, allowing board functions with inadequate supervision. This blend of weak governance and insufficient regulation has led to repeated corporate breakdowns. In many cases, board and executives operated legally, although some of their actions were neither ethical nor in the best interest of stakeholders. Their behavior, while lawful, frequently did not meet ethical standards nor prioritize the well-being of shareholders, employees, and other stakeholders. This gap between legality and ethics have sparked concern about the adequacy of current laws in promoting responsible corporate conduct. It says the law offers some guidance on minimum standards for board members' behavior, but the question is the law enough? We all know the law provides a baseline for board members' behavior, establishing minimum standard to ensure a degree of accountability. The law provides a baseline for a board member's behavior, allowing for actions that are legally permissible but ethically questionable. So what are the three clear duties that the US law imposes on board members? Let us get to know about it. First is the duty of care, which is about to define to be the practice of exercising reasonable care by ensuring the executives fulfill their duties and adhere to legal requirements. Next is the duty of good faith, which requires obedience that needs faithfulness in the mission of the organization. And lastly is the duty of loyalty that needs board members to demonstrate loyalty by providing undivided allegiance, which making decision the impact of organization. Take note that conflicts of interest are not always to be resolved in favor of the organization. According to federal sentencing guidelines, it suggests that board must exercise reasonable oversight with respect to the implementation and effectiveness of the ethics or compliance program, and that program must have enough resources, levels of command, and direct access to the board. Under the law, there is ethics. There are questions that we assume law could answer, but until now remain unanswered, such as whom does the board represent? Who are its primary stakeholders, ethically speaking? And if the board is aware of an unethical but legal practice, on what basis can the board require the practice to cease? Such questions are corporate governance law. Uncertainties encompass determining whom the board represents, recognizing its main stakeholders, and establishing grounds for halting unethical yet legal practice. Some argue that boards have a duty beyond legal compliance to actively investigate and understand the organizations they oversee. This includes identifying potential threats to the firm and anticipating competitive actions that could exploit these vulnerabilities. Board members must provide effective oversight, which necessitates having comprehensive answer to these critical questions.
Uncrotty emphasizes the need for continuous, rigorous, and transparent scrutiny of corporate executives. She argues that their decisions significantly impact the society's economic well-being, affecting employment, environmental policies, financial market, and consumer confidence. Mismanagement or unethical behavior can lead to severe consequences like economic crisis and job losses. Conflicts of interest in accounting and the financial market are significant issues that extend beyond the boardroom and affect the entire financial industry. Trust and the structures that support it are crucial for everyone involved. This conflict, whether real or perceived, can undermine trust because stakeholders often have varying interests. Accounting is inherently a system of principle designed to present a business financial position, operational result, and cash flow accurately. The goal is that by adhering to this principle, financial reports will be fair, accurate, and easily understood by others. The role of an accountant, whether as a watchdog or a greyhound, depends on whether they are employed internally or externally, highlighting the potential for differing levels of objectivity and scrutiny based on their position. The American Institute of Certified Public Accountant publishes professional rules designed to prevent accountants from encountering conflict of interest. The Financial Accounting Standard Board establishes generally accepted accounting principle or GAAP, which outline the method for gathering and reporting financial information. Additionally, accountants must adhere to the IACPA Code of Professional Conduct. However, a question arises: can this standard keep pace with the rapidly changing accounting and financing activities in a newly emerging firms? Executive compensation is a highly scrutinized aspect of corporate governance and finance. In 1965, the average CEO earned 20 times more than the average worker. But by 2000, this disparity had increased dramatically, with CEO earning 376 times more. Even after some decline, the ratio remained high at 271 times in 2016. Such compensation packages raise numerous ethical concerns. From a virtue ethics perspective, terms like greed are often used to describe the moral character of those who receive this excessive payment. These disparities also lead to fundamental questions about distributive justice and fairness in the corporate world.
Executive compensation. Serious ethical challenges arise against these practices, even from within the business perspective. Beyond issues of personal morality and economic fairness, excessive compensation raises ethical issues of corporate governance and finance. In theory, compensation packages serve interest in two ways. First is they provide an incentive for executive performance. Second is they serve as rewards for accomplishments. But in practice, reasonable doubts exist for both rationales. First is, in many cases, there is no correlation between compensation and performance. Also, there is a diminishing rate of return on incentives beyond a certain level. Another crucial governance issue is the disincentives that compensation packages and reliance on stock options provide. First is that executives have incentive to focus on short-term stock price rather than long-term corporate interest. Second is a case can be made that stock options may be to blame for the corruption involving managed earnings. Lastly, excessive compensation can also involve a variety of conflicts of interest and cronyism. Another large concern is the cross-fertilization of boards. Provided in this figure are the duties of the board and senior executives that may give rise to conflicts of interest, where duties of board members ensure executives are fairly and not excessively paid. Second is evaluate the executives' performance, while the duty of senior executives involves CEO often serves as chair of the board of directors, often hand selects members of board of directors. Lastly is compensation received by board members is determined by the end by the chief executive officers.
Insider trading can involve the unethical misuse of proprietary knowledge, which is exclusive to the firm and not meant for personal gain. This practice is considered unfair and unethical as it disrupts fair pricing based on equal access to information. The question remains whether current market deterrents are sufficient to discourage insider trading effectively.